So guys, let's look at the problems on page 368. Determine the deductibility on the code section 162 and 195 of expenses incurred in the following situation. Include a doctor unexpectedly inherited a sizable amount of money from the eccentric millionaire. All right? So we know, right, Evelina, when he inherits the money, taxable or not?
None.
What's your authority? Janet, Costello, you're going to say? Don't say 10-15. Again? Alicia?
112.
102.
102, guys. Can't forget little old 102, right? 102. Hey. Again, you don't know where the client's going, so you gotta, you're reading along, you're thinking different things. Yes, inherited, by the way, you're thinking 10-14, you're not thinking 10-15, right? 10-14 deals with the basis of inherited property, 10-15 deals with the carryover basis of their gifts. 102 says knowing. Tycoons decided to invest a part of her fortune in the development of industrial properties, and she incurred expenses making a preliminary investigation. Okay? Are those preliminary investigation expenses Tarina deductible? Larry, see if you agree.
Not deductible.
Not deductible. Larry, agree? So Jesse, if you agree, what section governs? Katie, you want to draw one?
I agree that's not deductible, but I don't know the code section.
Tina? Tina? Say it loudly.
162 because she's not carrying on business, true business. And then
162 prohibits the deduction if it's not carrying on the trade business. So what code section would govern these?
195.
195, right? Everybody agree? 195.
195C1.
Say again?
A1 says
195. Yeah. We don't know the amount, so we don't know, but it has to be 195 expenses amortized for over 15 years. Question B. The facts are the same as A, except that Tycoon, rather than having been a doctor, was a successful developer of residential and shopping center properties. Okay? Johnny, deductible or not? Deductible. Louise, agreed?
I'm not sure.
Zach?
I agree.
Why?
Is it carrying on their normal business?
Generally, expansions of existing businesses, this is not a new business, this is an expansion. Generally, expansions are deductible, 162. Okay, expansions are deductible. How about the facts are the same as B above, except that Tycoon, desiring to diversify her investments, incurs expenses in investigating the possibility of purchasing a professional sports team. Okay, so now there's a diversification element. Luke, deductible or not?
Non-deductible.
Not deductible. Jackie, you agree?
Yeah.
What's your authority, Jackie?
Is it 195?
Yeah, 195.
Yeah.
And question D? 1D, the facts are the same as C above, except that Tycoon purchases a sports team. Okay? However, 2 years after his fortunes turn sour, if she sells the team at a loss, what happens to the deferred investigation expenses? Deferred investigation expenses. Okay, Alicia?
So investigation expenses are deductible as startup costs, and unamortized are also deductible over the 2 years. Whatever is left over, she can deduct as loss according to section 165.
We'll look at 195B2. 195B2 says, in the case in which any trade or business is completely disposed of by the taxpayer before the end of the period, which is 15 years, any deferred expenses attributable to such trade or business, which were not allowed as a deduction by reason of this section, may be deducted under 165. So in other words, Alicia, I just want to create a bridge to get us to 165, which would allow this loss, okay? So 195B2 creates a bridge to get us to section 165. Luca?
C, you said was deductible 195 or non-deductible 195?
C, we said had to be, well, you had to capitalize under 195 and start advertising over a 15-year period. Okay, so for your notes, problem 1C, capitalize, right? And then you start advertising over a 15-year period.
165.
Right? Question 2. Law student spouse completed secretarial school just prior to entering law school. Consider whether the spouse's employment agency fees, let's say are $20,000, just put a number to it, are deductible. Okay, so everyone have it? The agency charges a flat fee of $20,000 to get a new job. Suppose the agency is unsuccessful in finding the spouse a job, deductible or not. Jessica, Nick, what do you guys say?
Not deductible?
Why not?
Which is her book will carry on. But the deductible?
Nick, you great, not deductible?
I think this pertains to the Lee case. I'm not sure exactly what.
No, this one doesn't. This is revenue rolling rate, Matt, 75-120.
Okay.
And here, since it's a new trader business, you have revenue rolling 75-120, let's say it's not deductible.
It's a new job title.
New job, and individuals really can't qualify under Code Section 195. It's not considered a new trader business for the individual. How about agency is successful in finding spouse job? We got Wes, we've got to make it deductible. David, we've got to make it deductible.
I'm not sure.
David? Who said it? Wes?
Yeah, I think we should do that.
Think you could?
Yeah.
David, yes, no? Sure. Louis?
I want to say yes.
Costa, do you have your
I
hand
don't
up?
think successful.
I think.
And Luke, do you have your hands up too?
Yeah, so it'd be deductible under the public case?
Not yet. We're not getting to Hunley yet. But here, the fee, here you're going to say,
Is it under revenue that's deductible?
it would be under the revenue line. Nikisha has 75-120, not deductible. Okay, because it's a new trader business. What was that, Nikisha?
That's what I was going with, like, figured whether it was successful or unsuccessful, it's still not deductible.
Right.
So just figure
Same as question B above, except the agency's fee, and Luke, now you'll have the honors. The agency's fee was contingent upon its securing employment for spouse, and payments will not become due until spouse has begun working. So Luke, what do you say here?
Deductible under the
Why?
Hudley case.
Under the Hunley case, now, the taxpayer is able to successfully bootstrap himself in where now he's carrying on a trade or business and as a cash method to the taxpayer, the obligation has arisen, right? And that's what Hunley was successful, said, look, I made the payment when I was already carrying on a trade or business and therefore it should be deductible. I question it. I don't, to me it's a little bit quirky, but you do have case law that supports this proposition. That if you make the payment contingent on getting the job, you can transform it into a deductible expense. Question D. Same as A and B, except that spouse previously worked as secretary in Old Town and seeks employment in Newtown where student attends law school and pays a $20,000 agency fee. Alicia, Matt, what do you guys say? Deductible or not?
I haven't read the verbatim really, but it sounds like it could be deductible.
No? Any gut instinct? Sure, Nikisha, what are you saying?
I would say deductible because, yeah, deductible. It's still
Tommy, agree,
secretary-
disagree?
It's still secretarial work.
I think it's deductible because it's not a new trade or business.
Right. It's
Yeah.
perpetuating an existing trade or business. It's not a startup expense. Just trying to find continued employment. So this would be deductible. My authority, Revenue Rule 75-120. How about question D? Same as D, except that agency is successful in finding spouse a new job, or a new town, a new job as a bank teller. So in this case, Edward, Nick, what do you guys think? Deductible or not? Edward, agreed? Was that, Edward? Agreed, right? Because it's a new trader business. It's a different line of employment. It's akin to a new job. When I say new job, an entirely different sphere of work.
And what does it say, because I'm a little confused, does it say somewhere in the A and B that it is a new employment?
Any question A and B?
Yes.
It's new job, right? Agency is being hired for a new job, right? By the very nature of an employment agency, it's going to be a new job, right?
We are assuming that. It doesn't say-
But it has to be. I mean, why else would you hire an employment agency,
Well, they moved from Old Town to New Town,
right?
and B,
But
it was.
the person just completed school, so they never had a job before. In column 2A and 2B. Remember, the taxpayer here just completed secretarial school. So it's got to be a new job.
Yeah, okay.
All right, Karen?
So in D, is that just deductible, like as a miscellaneous itemized deduction for that person?
So which question?
In D, because it's deductible, but it's really only deductible if she has enough?
Yeah, it's going to be subject to code section 67. It's going to be what's called subject to 2% miscellaneous itemized deduction. It's an unreimbursed employee expense. By the way, Karen did point out during the break, so I want to give a little hat tip. That came into here. We were talking before the break about that $5,000 de minimis, and Karen apparently pulled up the current version of the regulations, and the current version says 2,000, not 5,000. So apparently this edition, the new edition, the 18th edition, has a typographic error, okay? So, warning to the wise, whenever you're doing tax research,
We'll need
No.
all textbooks.
So you know, well, this is a new textbook, but they got it screwed up. But that can happen. So, you know, to save your high up, you definitely want to check online. You want to check 2 or 3 different sources. Make sure you have the right numbers. All right? So we're moving on. So we looked at code section 162, and we looked at the prefacing language, but then we have to look at 162A1, a reasonable allowance for salaries and compensation for personal services actually rendered. And we have our first case here. Authored by a judge. It's not a justice, not a Supreme Court judge. He sits on the 7th Circuit, which he's probably rooting for the Cubs tomorrow night. He's out of Chicago, the Chicago school. Judge Posner, by the way, probably one of the most prolific judges. Not only does he regularly write opinions, if you ever go to, in the New York Times Book Review, I swear this guy every second week has a new book coming out. This is incredible how prolific he is. Having said that, he was actually a candidate for the Supreme Court, but he's very much from the economic school, conservative economic school, and he was considered a wild card for the issue of abortion because wasn't sure his economic calculus would he say which one should be considered. So he was considered too much of a question mark and turned down to get as a Supreme Court nominee. Putting that to the side, we have this Exacto Spring Corporation. So, Katie, you have a chance to look? No. Oh, really? Karen, we haven't heard from you aside from...
This is exactly where I left off.
Left off?
Exactly.
James? Alicia, you have a chance. Yes. Just say it loudly because everyone's behind you as opposed to in front of you.
So the issue in this case is what is reasonable compensation?
Okay, because bearing in mind that adjective reasonable, only if it's reasonable is it deductible. Agreed? And if it's an incorporation, just by way of contrast, if a C corporation, a corporation under subchapter C of the Internal Revenue Code, that begins with code section 301, as opposed to an S corporation, which is not a tax-paying entity, that begins in code section 1361, okay, subchapter S of the Internal Revenue Code. So C corporations bear their own tax, right? There's a double tax, so-called double tax, right? You're not going to be tested on this, but so if a corporation earns $1 million, often at the end of the year, if you're a small business owner and your corporation earns $1 million, what do? You look in the mirror and say, you know what? I deserve $1 million because I am that corporation. The corporation and I are alter egos, right? So you pay yourself $1 million compensation and you hope to get $1 million deduction, right? And the corporation pays 0 tax. Agreed? The IRS can come back and say, no. Reasonable compensation in this context is $400,000. So the $400,000 that you got is reasonable. That's compensation. The other $600,000 is non-deductible to the corporation, and that's a constructive dividend to you. So you pay tax, an employment tax on the $400,000. The other $600,000 is taxable to you as a dividend, but the corporation doesn't get a deduction, so it has to pay tax on $600,000, and that's essentially under code section 11, a 34% tax. Okay, so you can do the arithmetic. The 34% tax on $600,000 probably got $200,000 of tax, right? Approximately. Right, so that's not a good day, right? If the IRS comes back and says $1 million is not reasonable, but rather So everyone understand the stakes. They're pretty significant. All right.
So Exact Sporting Corporation, they make springs.
They make springs, right?
And the principal owner, Mr. William Hines, he actually did everything. He was an engineer, so he worked on production, he worked on sales, marketing. So he was very, very involved in the whole process of everything, starting from design, production, and sales, acquiring customers. So at the end of the year, he paid himself $1.3 million as a compensation.
Okay, nice. 1.3 for 1 year and 1 million for the other year. And the IRS comes back and says, no, not so fast. We think a reasonable salary instead is 381 and 400,000, right? And what does the tax court do? So you get these very polar point of view, right? What does the IRS say?
IRS says too high.
I mean the court. How does the court resolve it? The lower court? Say again, Buster? Well, they essentially add the two numbers together and split it in half. Voila. So they split the baby in half. Everyone gets the visual? They take the IRS number, they take the taxpayer's number, they add the two, divide by two, and they say, gee, this must be reasonable. Now.
And for that, they use the very elaborated test of 7.
There's multiple factors, right? There's a so-called multi-factor test that some courts use a 7-factor test. Some courts have used a 21-factor test. Are judges well qualified to ascertain what is a reasonable salary? Are they trained?
No.
No. I mean, on good days, they theoretically know the law. They're not trained in economics, right?
So,
Now, if Jay Solid had his way, some of you getting back to baseball, Luca, James, you might appreciate this. Or Nick, I forget who's into baseball these days. Luca, you know, if I could say to the taxpayer and the IRS, look, I'm the judge. I am going to pick between, I am not going to be able to pick, I am going to pick one number or the other number, meaning something akin to free agency, where whichever number comes closer to what I think is accurate is the number I'm going to pick. Okay, so picture, if you will, if I'm going to, again, this is hypothetical, but suppose the theory, a judge could only pick one number, and it was one of the two numbers the IRS offered or the taxpayer offered. What do you think would happen when the IRS came back or the taxpayer came back? They come back with high numbers or low numbers. Wouldn't they try to moderate, right? Because if courts do what the tax court did, it gives an incentive to be extreme, right? Because the more extreme you are, the better the outcome. The more the taxpayer takes in the form of salary, okay? And the more the IRS says, nah, he should be paid only $1. The more extreme you are, the better the halfway point. Everyone agree? But if you had this first offer arbitration where whatever is the closer of the two numbers is the one chosen, it forces each side to be as reasonable as possible. That's not the law. So Judge Posner says, you know what? He looks at these multi-factors, right? Alicia, what does he determine when he applies this multi-factor
well, he
test?
decided it's garbage. It's not useful for that purpose.
Yeah, he looks at these factors, and when he goes through each of the factors, he says, who would prevail?
Well, I don't understand the question.
Well, and I'm not trying to be cryptic, but he says that under these facts or factors in evaluating our taxpayer, in virtually every instance, the taxpayer here, the salary paid to him was justifiable. In other words, if you look through each one of these factors, they were in the taxpayer's favor. So even though with the 7-factor test, it all supports the taxpayer's position, somehow, when the court was done with it, the lower court was done with this analysis, sort of says, we still have to split the difference, okay? So Judge Posner is very, feeling very empty about this kind of analysis. So what does he say should be done instead?
He said they should look at the independent investor test. You should look at return on investment, how much the company gets as return on investment.
Right. In other words, how much would the Judge Posner on page 375, the second full paragraph on page 375, a few lines down, says this is material and the quote-unquote independent investor test, like the multi-factor test that it replaces, doesn't complete, no invaluable. And he goes on about the virtues of how much would an independent investor like Alicia be willing to pay this guy annually for the services he contributes. In other words, depending on how much Alicia puts into corporate entity, she's a shareholder, depending on her return, the greater Alicia's return, the greater she would pay, right? The higher salary, right? Wouldn't everyone in this room, that if you're getting a great return on your money, you'd be willing to pay that corporate officer more. Agreed? And he says, based on that independent investor test, he feels that these salaries, the 1.3 million and the 1 million paid, were very reasonable in amount because the investors here were getting a very good return. All right? It upholds the salary as being deductible in its entirety. The problem, if you don't mind me saying, is that it is very hard to know what independent investors like Alicia might be willing to pay in the form of salary to someone, right? So notwithstanding that he thinks that the multi-factor test is kind of hogwash and it's too hard to apply, and he has his parade of horribles. Truth be told, I'm not sure if his test, which by the way, I'll add parenthetically, this case was rendered now many years ago, not a single other circuit court has followed. So notwithstanding what I said was the brilliance of Judge Posner, and I guess I admire him for trying to take a new stance and approach towards what is reasonable. I don't think it adds that much more to the conversation. So he's also another version of this test. It is certainly not the final word. And was it you, Wes, or David, who was saying, well, is there a certain threshold amount when it comes to roofs, for example, or expenditures, where you say it's got to be capitalized? This is the kind of area where there's no perfect answer, okay? Just, it's the kind of thing you got to warn your client. Okay? Because I know, and you know, many clients, towards the end of the year, if they're closely held business, I would say 99.9% will come to you at the end of the year and say, look, I don't want to pay any corporate tax. I want to take the entirety of whatever's here, paid in the form of salary, right? If you haven't heard that, you will hear that. I am sure you will hear that. And then your role as advisor is just to tell them that, look, there is this code section 162 that may put the brakes on what's going to be permitted. And be forewarned that if the IRS comes back, your corporation on its Form 1120 may owe significant tax, interest, and penalties. And this is not where you get carte blanche and you necessarily deduct the entirety, right, of whatever you deem appropriate. All right? So everyone good? Everyone understand? And Exacto springs it up, again, end the conversation. We have another case, Harold's Club, that takes us a step further. What does Harold's Club say? I got it. Each time I turn a page, has to be more optimistic about those who are ambitious about how far we would get tonight. So Karen, I know you stopped before, so I can't ask you. Evelina, did you think we'd get here? Nick, did you think we'd get here?
I think so, but I'm not, I have to remember what it was about.
Anyone want to jump in? Please?
I can start.
Nick, hold on. Nick, we got another Nick, and then Alicia can feel free to jump in. So we got lots of participants. So Nick, tell us what happens.
So this one owned the Corporation Health Club. Operated a number of casinos in Nevada. Smith ran the casino but didn't own any stock in the company itself.
All right, so hold on. Who owned the company? I'm sorry?
Smith's son.
Sons, plural, right? So picture, if you will, Smith, the taxpayer here, has, or it's not the taxpayer because the club is actually the taxpayer, has two sons, right? And they're quote unquote running the company, but who's really running the company? Smith. Okay, so dad is really running the company, right? And the company's very profitable, making big money, $1 million, $2 million given the years involved. And Smith is being paid pretty significant money, okay? Smith is being paid pretty significant money. In fact, on the face of it, the amount he's being paid is in excess of what is reasonable, okay? Everyone understand that he's being paid in excess of what is reasonable. I want to draw your attention, then we'll go back to this case, but there's a regulation that is pivotal to your understanding this case. This regulation is 162-7B. And in particular, regulation 162-7B2. Did everyone have that? Regulation 162-7B2. If you look at 6 or 7 lines down under 162-7B2, it says, generally speaking, if contingent compensation is paid pursuant to a free bargain, I have the two words free bargain highlighted in red, between the employer and the individual made before the services are rendered, not influenced by any consideration on the part of the employer, other than that of securing fair and advantageous terms, the services of the individual, it should be allowed as deduction, even though in the actual working out of the contract it may be proved greater than the amount which ordinarily is paid. So what is this saying? That if you have a contingent compensation arrangement that's freely bargained for, that the amount will be deductible even though it's beyond reason. So what this means is that at the beginning of the year, if Nick were to negotiate a deal, say with his accounting firm, and he said, look, if gross proceeds exceed $1 million, for every dollar, and let's just say Nick's base salary is $100,000, And for every dollar the gross exceeds $1 million, Nick gets 20%. So if the firm grosses $3 million, on that $2 million, he's gonna get an extra $400,000, right? 20% of $2 million, right? And at the end of the year, Nick gets $500,000. And I know, Nick, you're worth every penny, but you say just normally.
Thanks for being sarcastic.
No sarcasm. Normally Nick would be paid $150, but under this compensatory arrangement, I ran the visual, he's being paid $500,000, right? Would that $500,000 be deductible? And that was a yes, right, Nick?
Yes.
Other Nick, right? Because it was freely bargained for compensation arrangement. It could have gone either way, right? He could have been, maybe the firm didn't reach this $1 million goal, and he would have only been paid $100,000 rather than his normal $150,000 salary. Here, maybe because Nick brought so much to the table that the revenue of the firm, gravitated way upwards, right? And therefore, because it met the requirements of 162-7B2, it was held, or would be deductible. Everyone have that? That if you enter into contingent kind of payment arrangement, it's freely bargained for, even though it may result in unreasonable compensation, it would be deductible. Agreed? Make sense? So even if Nick were paid $2 million because the firm's revenues were off the charts, $10, $12 million. And no one could have anticipated that. Deductible. So what's the contrast, or what's going on in Harold's Club? Okay. So everyone has the relevant regulation because that's going to dictate the outcome in Harold's Club.
Well, they deducted the salary as a business expense on their own tax. Payment to employees, there's very good fees in there. It was denied by the IRS.
So they try to deduct the salary, denied by the IRS as being unreasonable. The taxpayer tries to rely on this regulation. Keep going.
IRS argued under 162A1 reasonable allowance. Harold's Club argued that even if the salary was high, it was only because the casino made a lot of money. Under his particular leadership, the contract gave him that percentage.
And on page 378, 4 or 5 lines down, on page 378, says that it concluded that the 1941 salary agreement was not the result of a quote-unquote free bargain within the meaning of the code of regulation, and that it therefore reasonable must be judged at the time the compensation was paid. In reaching this conclusion, the court placed primary reliance upon the family relationship between Smith and his employers in 1941, and circumstances indicated that he dominated them at that time. And look at footnote 3. Footnote 3 is trying to delineate the domination of the father over his sons. In the view of the family relationship existing between Harold and Raymond, the employers, and Smith, the employee, the ages and experience of the employers, Smith's domination over his sons in the past, the respective roles and duties of the sons in Smith and Harold's Club creation and organization, and the reasons offered by Harold and Raymond for agreeing to Smith's suggested compensation. We cannot say that the petitioner has established the original employment contract between Harold's Club and Smith were the product of a free bargain for arm's length transaction. So in other words, what the court is saying, the lower court is, regulation 162-7B2 has no application here. There's no free bargain. Everyone agree? If you don't have a free bargain, then you can't rely on the regulation, and you're back to just the generic rule of 162 reasonableness, right? And we ain't got it, right? Right, Nick? That's what the court holds. That at the end of the day, this compensation arrangement was unreasonable and should not in its entirety be deductible. right? So at the end of the day, the IRS prevails. Right, now. On page 381. There's discussion of a $1 million ceiling. These are some things that the authors of the book want to call our attention to. Now, this is under Code Section 162M, $1 million limitation. But it's got a major loophole, this limitation. That if the compensation is geared to what are called performance goals, this limitation doesn't apply. So most public corporations put extraordinarily low performance goals in front of their CEOs. So if they get paid $100 million, which some CEOs get paid, fully deductible. 162M doesn't set a limit. Nikki, should you want to say something?
No, I'll keep it for myself.
All right, so again, a politician could say, gee, we tried to put the brakes on egregious payments to CEOs, look what we did. But the truth of the matter, no one put the brakes on anyone, right, Nikisha?
No, I guess that they find loopholes.
Well, there was a loophole built in, they didn't have to look too hard.
That's, yeah.
What happens when politicians get their pockets lined?
What was that, Nick?
What happens when politicians get their pockets lined?
Yeah. All right, and then, so that's Code Section 162M.
Sorry.
And then there's golden parachutes. Once again, Congress trying to put the brakes on people who get excessive sums if the company is taken over. This is under Code Section 280, capital letter G. That an excise tax has to be paid. If you look at page 382, the first full paragraph towards the end, it says, Section 280G lets the heir of a golden parachute by prohibiting Code Section 162 deduction to the payroll corporation for excess parachute payments and by tagging the recipient of such payments with a 20% excise tax in addition to income and social security taxes. And so it's a double whammy. The corporation has a limitation on what it can deduct, and the recipient pays an excise tax. What is it? What's a golden parachute? It's generally 3 times the individual's base salary amount. Payment in excess of 3 times the individual's, 3 times their base amount. All right? Let's look at the problem on page 383. Employee, majority shareholder, and president of corporation. Shortly after the corporation was incorporated, its directors adopted a resolution establishing a contingent compensation contract for employee. The plan provided the corporation to pay employee a nominal salary plus an annual bonus based on a percentage of the corporation's net income. In the early years of the plan, payments to employee averaged $50,000 annually. In recent years, corporation's profits have increased substantially, and as a consequence, employee has received payments averaging more than $200,000 per year. Okay? What are the corporation's possible alternative tax treatment for the payments? Go ahead, Alicia.
So first of all, we see that this is a majority shareholder, so he exerts control over the corporation.
Okay, so
he pretty much decides. Okay,
so this is, you know, for all intents and purposes, a wholly owned corporation. Going to be problematic to prove free bargain. Everyone agree? Very hard to prove free bargain. But notwithstanding, you know, as I described before, how could the corporation treat this payment? Could be, Luke?
Salary or dividend?
Right. Generally, it's going to be one or the other. It's going to be deductible salary payment or non-deductible dividend payment. Probably. What factors should be considered in determining the proper tax treatment for the payments? What are our choices here? Luke, you were going to say? You're on a roll.
Is the salary reasonable, and is it really distinguished as a dividend?
Well, how would you determine how is it reasonable? What would you do?
Is it freely bargained for?
No. We know that, let's assume that we can't rely on a freely bargained for.
Is it reasonable?
Yeah, how would you decide if it's reasonable or not?
Look at the return available to the investor. Like what?
Okay, so you might subscribe to the Judge Posner test of how would an independent investor calibrate what is the appropriate salary, right? That could be one approach. Or the other approach would be the multi-factor test, right? That most other courts have subscribed to. So we generally, at least for now, have two choices. Multi-factor test, or we could rely on Exacto Spring for this proposition of what would an independent investor say is a reasonable salary under these circumstances, right? The problem assumes employee always owns 248 of the corporation's 250 shares. Might it be important to learn that the compensation contract was made at a time when the employee was a minority shareholder, only owning 10 of the 250 shares?
That would change things.
Say again, Nick?
That would change things a lot at that point.
What would he do?
Well, there's bargaining there at that point because he's a minority. It's not like he said, okay, I'm just going to appoint this myself because I can. There's the ability to bargain at that point. And then he, over time, bought more shares in the company.
All right, so if this original contract was entered into when there's 10 out of 250 shares, it suggests that contractual arrangement was 10 out of 250 that he was a minority shareholder. At that point, you have two even parties, right? A minority shareholder and bargaining with someone who owns or multiple people who own 240. That's freely bargained for, right? That's a hard negotiated contract. So that contract probably has indicia of legitimacy, maybe, not definitively, saying that the taxpayer has a much more likely chance of being able to invoke Regulation 162-7B2 and say, look, at the time that contract was entered into, it was really bargained for, it should withstand scrutiny even today. Does that prevail? I can't tell you, but it's a decent argument. You guys good? All right. Now I'm really venturing because each time I turn the page, there's less likelihood. All right. Let me talk about the Rosenspan case. Okay. And let's talk in general about travel away from home. Now, if you look at code section 162, A2. Everyone have it open? 162, A2. And if you don't, if you could, that would be great. You're allowed a deduction for traveling expenses, including amounts expended for meals and lodging, other than amounts which are lavish or extravagant under the circumstances, while away from home in pursuit of a trade or business. Everyone see that?
Mm-hmm.
And an issue that comes up in the Rosenspan case, and in many of these travel cases, is what does the word home mean? Seems simple enough, right? What does the word home mean? And Tina, what could it mean? What are the possibilities in your opinion? Where you live. Might not be a bad answer, right? And Jia Ying, is that the only possibility? Home, Nick, you had your hand up?
Yeah, I would think it was just, you could also define it as your home base of work, where you know how to work.
It's your place of work, right? Everyone agree? Home might be the traditional home sweet home, or for many of you in this room, you might spend more time at the office than you do at your house. Kind of sad reflection of life, but sometimes true, right? Particularly during tax season, right? So, historically, what position has taxpayers taken and what position has the IRS taken with respect to what does the word home mean? Traditionally, taxpayers have said, in most cases, that home means home. There's a surprise. Home means home. The IRS, by contrast, often says home means business headquarters, right? So everyone, there's this unsettling notion that home does not mean the same thing to all the parties. Right? Now, there are two code sections, and you guys should start getting used to this. Code section, you know how we said 162 is limited, right, by code section 263. There's capitalization rules. Agreed? 162 is also limited by code section 274, which you should open up. So keep your fingers on 162, but open up to code section 274. which is entitled Disallowance of Certain Entertainment, etc. expenses. So even if the expense is ordinary and necessary, Code Section 274 can put a haircut on the deductibility of an expenditure. And one of the quintessential limitations on deductibility that most of you and your clients are going to be familiar with, right, is Code Section 274N. Section 274N. It says only 50% of meals and entertainment expenses are allowed as a deduction. So even if the expense is ordinary and necessary, Code Section 274N, and I'm just using this by way of example, puts a limitation of 50%. In years past, this number was 80%. You used to be able to deduct 80%. It's now 50%. I've seen many members of Congress, Taxation, you'll appreciate this, from lobbying efforts saying from the restaurant industry, let's raise it to 80%, up to 80%. Several other people will say that that shouldn't be the case. It should be lowered to 20%. Okay, so there's no one right answer. I just call to you that this is a political decision, and it really depends on where you sit on the political aisle and where you work and your thoughts about restaurants and deductibility and whether or not this even belongs here. Some people would argue, and I might be among them, is that with respect to business entertainment, it sounds like an oxymoron, right? That business entertainment should not be deductible. Everyone agree?
The Christmas party.
By the way, Tahir, if you get bored, Tahir, can you just, are you on Google or?
I can go on Google. Yeah.
Just type in J Solid and skyboxes.
Oh, New York Times article.
So, if you guys want to see my position, a few years ago I had an op-ed on this exact issue. And let's put it this way. My position is business entertainment, I have my strong misgivings about business entertainment being deductible. And let's say this, that Jessica, if you are taking clients out to a show, and normally you go to a Broadway, Hamilton, and you spend $500 on a ticket, right? You got cheap tickets, right? $500. Presumably, if you go with your family, you're enjoying 500 oodles of enjoyment, right? But if you go with clients, hey, J Solid, your marginal utility may not be 500. It may be, I'm going to talk tax. You're like, got to deal with him. Your marginal utility is going to be like 100, right? Something like, So this notion of business entertainment could diminish, right, the utility you enjoy from attending these events. And I'll just share a story of like my naivete, which is never hard to do, is that when I wrote that op-ed for the Times, Fox News said, oh, Professor Solid, why don't you come in, we'll interview you. And naivete me thought, oh, this is great. They want to hear what I have to say about entertainment expenses. So I went in there thinking, like, this is going to be a lot of fun, and I'll just explain, and they'll want to hear me pontificate about deductibility or non-deductible business entertainment. Well, it was a 3-on-1 bloodbath, and I was the guy because
was that on YouTube?
I hope not. Not to my knowledge. All right? Because, like, all of a sudden they said, "Oh, Professor Solid, do you want to ruin business because you know how much business is done on golf courses,
That's what I was gonna say.
restaurants. You're taking away the life engine, the life blood of entertainment expenses. Where are you getting off? And I was like a deer in the headlights. Like I had no expectation I was going to be crucified. And in retrospect, I wish I had thought harder about that. And there was one good thing that came of that. Last year, I was, and this one I think if you dig deep enough, you'll find it. I just
on YouTube.
Not the Fox News one.
Larry, what more show?
I just see like the lavish employee perks cost US billions and lost tax.
No, that's a different one. I was at the Larry Wilmore show last year, and I decided to have fun with it, as opposed to Fox News, where I just got completely surprised by it. So on the Larry Wilmore show, I had more fun. So if you dig that one up, you may be semi-entertained at my expense, which is fine. But if you want, feel free. I do talk about deductions, okay? So it has some relevance to our course. If you know the Larry Wilmore show, the guy, his name, I forget his last name is Miles. He wants to know if buying pot for his son would be deductible. So anyway, I'll share that with you.
All right.
Lots of videos. All right, so guys, we have Code Section 162, limited by Code Section 274. My own opinion, many business entertainment expenses, you talk about an area of abuse, and so here, if you were to read the op-ed, it was that many new stadiums throughout the country that have been built in the last 10 years, that there's many more skyboxes that have been put into these stadiums as opposed to seats for the hoi polloi like myself. The nosebleed seats have disappeared. They haven't disappeared, but there's fewer of them because there's so much money for corporate enterprises to put these skyboxes in, and they're really being underwritten by the general taxpayer. All right, so I certainly have my misgivings about that. So in terms of code sections, guys, Rosen, let me just give you a lay of the land for our next class. So we're going to go through, just Karen, you ready? So you know how far we're going to get? We're going to get pretty far. So make sure you read ahead. We're going to read about Rosenspan and his plight, what's deductible and what's not. Andrews is a good case. I'm going to call to your attention in the Andrews case. Do not forget to read footnote 10. Footnote 10 is the footnote that unlocks the Andrew case. So even though it's a footnote, don't skip through it. You'll read the red ruling that follows. Now, this is not by way of trying to scare anyone, but the problems on page, look at the problems on page 401, 402, and 403. These kind of problems make for great multiple choice questions. All right, so listen, I'm telegraphing these things because the more you know about what's going to be on the final, the better hopefully you'll do, the better you do, the better I'll feel during my holiday break. So there's something to be said. So do pay careful attention to that. Now, once we go through 162A2, we will then go to 162A3, dealing with rental expenses, right? Rental expenses. And then we will look at expenses for education. Is your tuition tonight for this class, is it deductible? Not deductible. Those are the kind of questions. And regulation 162-5 is pivotal. You cannot possibly read this section and grasp anything of it if you just read the code. You must read regulation 162-5 to get a handle on this. So we will peruse educational expenses and see what's deductible or not. And we will, again, I don't know exactly how far we'll get, but if you read up to depreciation on page 428. I don't know if we'll get that far, but it can't hurt. Can't hurt.